Hi everyone, thank you for joining us for today's seminar. Before we start, just a quick reminder to please mute and turn off your cameras for the duration of the presentation. You are welcome to use chat function found on the right side of the screen to submit questions. This will be addressed at the end of the presentation during Q&A period. You're also welcome to get in touch with our firm to get help planning and organizing your business taxes. We work with many small and medium-sized businesses across Canada and other financial and accounting services that include personal and corporate taxes and tax planning. Our website is youraccounting.cloud. The link will be posted on the chat. Today's webinar will tell you about the top 10 mistakes taxpayers make. It is presented by Dale Barrett from Barrett Tax Law. Dale is a tax lawyer and best-selling author who has many years of experience working with a wide variety of clients in tax law. We are very grateful to Dale and his team for lending their time and expertise to us today. I will now turn the time over to Dale to start the presentation. Dale, go ahead.
Yeah, I'm here. All right, excellent. Thanks, Eugene. I appreciate being able to speak today. Again, I'm Bill Barrett from Barrett Tax Law, and we're going to be discussing all of the 10 big tax mistakes that are made by taxpayers. So without any further ado, I will jump right into the presentation. If you miss anything, if you want to get the slides from this presentation, get in touch with Eugene, or you can get in touch with me. My website is barretttaxlaw.com. So one of us will be able to get the slides to you. And let's get started here. Okay, so I'll just quickly go through the big mistakes, and then we will discuss them individually. So the number one biggest mistake is not knowing your rights. Taxpayers have a lot of different rights, and most people don't know that. Number two, not respecting deadlines. Number three, not taking advantage of the voluntary disclosures program. Number four, transferring assets between non-arm's length parties without considering the tax consequences. Number five, paying in cash and not keeping proper records. Number six, getting greedy. Number seven, not challenging a bad assessment or an audit. Number eight, not realizing that CRA policy and the law are two very different things. Number nine, acting as a director unknowingly or haphazardly. And number 10, not getting help from an expert. So mistake number one, not knowing your rights. A lot of people don't know that taxpayers have a lot of different rights, and a lot of these rights are outlined in the Taxpayer Bill of Rights. So if you all want to get to Google afterwards and check out the Taxpayer Bill of Rights, you'll see that there's 16 different rights that taxpayers have. Probably the most important one of them all is the right to pay what is correct, and of course the right to appeal an assessment that you don't feel is correct. And besides these Taxpayer Bill of Rights that are listed in the bill itself, we also have constitutional rights. There's something called the rule of law, and getting into the rule of law, it's something that we have in Canada and that they don't have, let's say, in North Korea. And the rule of law is a legal principle that law should govern a nation as opposed to being governed by arbitrary decisions of individual government officials. So that's just a fancy way to say that the law should determine the outcome in every given case. So whether you're going for a driver's license or whether you're filing your taxes, the law should determine what happens, not an individual clerk's decision. So if someone at the CRA, for example, makes a decision that is not based on the law and that seems to be unfair, there's a way to get around them. There's a way to appeal this. There's a way to go to court and to ensure that the rule of law is respected. Due process is another thing that we have in Canada and all Western countries that, again, you don't necessarily find in a communist nation like maybe China or North Korea. And due process, it balances the power between the state and the taxpayer, or between the state and the residents. So essentially what it says is that the state must respect all legal rights owed to a taxpayer, and the CRA is part of the state. It's an agency that is appointed by the government to deal with taxes, and the CRA must respect all of your legal rights. So that means that if the CRA harms a taxpayer without regard to the rights, they've violated due process, and they've also offended, therefore, the rule of law. And there's a mechanism to to right the situation, to rectify the situation. So it's very important that if you're ever in a position, or you find yourself in a position where the CRA has made a decision which seems to be just completely unfair and arbitrary, or if they seem to have done something which has violated your rights or due process, if they've done something that seems to be something that would be done in Korea, something that's not necessarily something you'd expect in Canada, then the odds are that they've violated your rights, they've violated due process, and you have recourses as a Canadian. Okay. Of course, going back to the most important rights, as far as I'm concerned, is the right to pay no more than and no less than required by law. So the Income Tax Act and the Excise Tax Act, they set out what a taxpayer needs to pay, and what deductions are available, and so on and so forth. And if you feel that either through an audit or by some mistake of the CRA, you're being charged much more tax than you anticipated or that you think is correct, you have the right to rectify this, as long as you do it within a certain time frame, and as long as you respect deadlines, which we'll get to in a few minutes. And as well, you have the right as a taxpayer, again, if you respect the deadlines, to object to assessments and to go through a process to have the CRA appeals division, or eventually to have a judge determine what is the correct amount that you should be paying. So very, very important to be educated about your rights. What you should know as well is there are certain rights that I call them sort of the public relations rights. You have the right to, speak to the CRA in either official language. You have the right to be treated courteously. You have some, rights to be treated decently and fairly and whatnot. And if those rights aren't respected, you should be going to the taxpayer's ombudsman, which is an independent office, and the ombudsman can make sure that, if you're being treated unfairly because of your race or your color or your sex or your sexual orientation or your language or anything else, they can step in and make sure that the CRA respects your rights and treat you fairly. So the second big mistake is not respecting deadlines. And I see this all the time. The most important thing that I see that is easily fixable and there's no need for is that many people don't file their tax returns because they can't afford to pay the amounts in question. So many people think that as soon as they file and they have to pay, and if they can't pay, they may as well just delay filing. But what people have to realize is that not filing one's tax returns is illegal. Not paying is not illegal. So there is a jail that one can go to, and they can throw you in the jail and throw away the key if you don't file your taxes. But there's no prison, there's no jail available for people who don't pay. So if you can't afford to pay, or you can't afford to pay now, there's no need not to file. And in fact, not filing on time will cause you to have interest and penalties. Of course, the interest will be there either way, even if you file and you don't pay. But the point is, if you file late, you're going to have late filing penalties. And if you file late more than once, you can repeat late filing penalties. So that just exacerbates the situation and makes it even more difficult for one to pay. So the takeaway point here is, even though you may not be able to afford to pay what's due, file on time. It'll alleviate the penalties at very least. Other deadlines you should be aware of are the deadlines to object. Okay, so if one disagrees with a notice of assessment or a notice of reassessment, which comes after an audit, for example, you should object. Okay, there's no need not to object. Objecting is the process that could lead to a rectification of the inconsistency of the error. So in order to object, there's a timeline of 90 days from the date of assessment or date of reassessment. Okay? And if you miss that 90-day period, you can actually get an extension for up to 1 more year. Now, don't wait for the extension. Even though it's pretty much guaranteed you'll get it, it's important to file on time. Now, in terms of the tax court, once the CRA has reviewed one's objection, if they don't agree with the taxpayer, they will issue either a reassessment afterwards, or they'll issue a notice of confirmation. And in that case, if you still disagree with the outcome of the CRA, you have 90 days to appeal to court. Now, the deadline to appeal to the Tax Court of Canada is a much more serious deadline than the deadline to object at the CRA. So while it is technically possible to get extension if you miss 90 days, I really, really do not recommend that you miss the deadline to appeal to the Tax Court of Canada. Because what ends up happening is oftentimes you'll be called in front of a judge, and you'll have to demonstrate to a judge why you think that they should let you appeal to the court even though you've missed your 90 days. Another thing is called judicial review. I should just discuss it briefly. There's a 30-day deadline in order to go for judicial review. And what judicial review is, it's basically a check and balance on the power of an agency. So, like I said before, we've got the rule of law. The rule of law says that, the CRA and the government has to make decisions according to the law, not according to their whim. That means as well that clerks within the CRA, they have to, they're given discretion on a certain number of things, but they have to use that discretion reasonably. Similarly to the people who are sitting in the driver's license bureau who are issuing driver's licenses, they have to use their discretion reasonably. So, for example, if you go and get your driver's license renewed and you walk in there drunk, or you're abusive and you're swearing at the clerks behind the counter, they have the discretion to tell you to go away and to come back another day. And if you were drunk or you were abusive, I'd say that's a reasonable exercise of their discretion. If you walked in there and they said, sorry, we don't like the color of your hair, and people with brown hair cannot renew their driver's licenses on Wednesdays, there's no law that says that. That's completely arbitrary. It's not according to the rule of law. That's not a reasonable expectation that they'd be saying that, and it's not a reasonable use of their discretion. So if their discretion is not exercised reasonably, similarly at the CRA, if you owe $100,000 and you're proposing to pay 10 grand a month, that in my opinion is reasonable. Most collectors would accept that, but if a collector is being unreasonable and they decide that they're not going to accept that payment plan, then you can go and you can have their decision reviewed by a judge, and that process is called judicial review. Okay, so you have 30 days from the decision of the CRA or any other administrative agency in the country, for that matter. You have 30 days from their decision in order to take it to court and have that decision reviewed. The third big mistake is not taking advantage of the voluntary disclosures program. So the voluntary disclosures program, for all of you who don't know about this, it allows people who have undeclared revenues or perhaps overstated expenses to come forward and get these items fixed. All right. So the way it works is if you go and you refile your returns, or you file for the first time amounts that were not declared previously, you can apply through the program to file those returns or to file those updates to your returns, and you can do so without penalties and interest. It's not that all interest will be relieved, it's that a certain amount of interest will be relieved. And certainly there are two types of the voluntary disclosure program. The one half is for people who are just honestly mistaken. They forgot to include a certain amount. They didn't realize that their foreign pension was taxable. And if you go through that branch of the program and they accept you, there are no penalties at all. The other branch of the program is for people who knew what they were doing was wrong. People hiding money offshore, people who were cheating the government previously, people who were drug dealers. They have a safe full of cash that they previously didn't declare. For those people, there's partial interest relief and there's partial penalty relief. But either way, regardless of which program one goes through, it's much, much more cost-effective to file your application and file your returns through the voluntary disclosures program rather than just going directly, okay? And there's a couple different conditions that have to be satisfied in order for an individual to qualify for the voluntary disclosures program. So number one, there has to be an error or an omission that was made, and it must be at least 1 year overdue. So something you forgot to file last year, it's not over 1 year overdue, you can't do the voluntary disclosure. It's something 2 years old, 3 years old, 5 years old, anything up to 10 years can be successfully applied for through the voluntary disclosures program. Secondly, the second condition is that the failure must involve a penalty. Okay, so the failure to declare certain income that would otherwise have a penalty if you didn't go through the program. Number three, one's disclosure must be complete. So that means that, let's say there's all kinds of stuff that you didn't declare. You have to come forward with all of it. Okay, you can't just pick and choose what you're going to tell the CRA. You have to come completely clean. So a partial disclosure, although it might succeed right away, if the CRA finds out that you've only made a partial disclosure, they can certainly go ahead and deny the application later on. And the fourth condition it's probably the most important condition, is that the disclosure must be voluntary. Well, the program is called the Voluntary Disclosures Program, and that means your disclosure must be voluntary. And what that really means is that if a related party was being audited and you learned that your business was being audited or your spouse was being audited, and then you kind of freaked out and thought, oh no, now that this related party is being audited, they're going to find the fact that I didn't declare certain things, it's too late to do a voluntary disclosure. If there's been any enforcement action directly upon you, for example, if there's an audit that's upcoming or you're in the middle of an audit, it's too late to come clean. If the CRA has demanded your tax returns or sent you reminders to file your tax returns, again, it's too late to come clean and go through the program. So it's best to take advantage of the program before the CRA has called you, before they've gotten in touch with you. And very, very, very good program, and it can save you tens of thousands of dollars, maybe even more. Now, mistake number 4, many people don't understand this, and many people engage in transactions with family members, and the mistake is transferring assets between non-arm's length parties without considering the tax consequences. So question number 1, what is a non-arm's length party? So non-arm's length parties are related parties. So spouses are non-arm's length, parents and children are not arm's length, people in their corporations are not arm's length. So what happens is when a transaction happens between these related parties, okay, which could actually even be between two corporations that are related, you've got a transaction called a non-arm's length transaction. And the interesting thing about a non-arm's length transaction, number 1, is that if any of you, I've looked at the guest list here, I don't believe I'm related to any of you. My corporation isn't related to any of your corporations. If any of you wanted to go ahead and sell me your rental property for $1, number 1, I'd buy it. Thank you very much. A great offer. But number 2, you're free to sell to me. I'm an arm's length party. We're at least an arm's length away from one another. We're not related. You're free to sell to me any of your assets at any price you like. As long as the two of us have agreed on a price, the CRA will never come in and tell us that the price was wrong. Okay? However, if you're selling an asset to a family member, you cannot sell to them at any price you like. Okay? There are certain deeming provisions in the Income Tax Act which say that if you sell an item to a family member, you're deemed to be selling it to them at fair market value. So for example, let's say you have a cottage property and you bought the cottage property at $100,000 and that's worth $500,000. It would be really, really convenient to be able to sell the cottage property to your kid, okay, for that $100,000 so that you wouldn't have any capital gain, okay? However, if you sell that property to your child at $100,000 and it's really worth $500,000, the CRA will deem that you actually sold it for $500,000. And the way it will work is they will deem it as a $500,000 sale, which will then trigger a capital gain on your part for $400,000. So you'll have taxes payable on that $400,000. But then what makes it even worse is on your kid's part, they will deem that your kid paid you the full $500,000. So they won't deem that the kid paid $500,000. They'll still accept that they paid the $100,000. And if they go next day and sell it to $500,000 to someone else, the kid will pay another $400,000 gain. So you could actually end up in a situation of double taxation. Okay, so if you sell it for $100,000 to your kid, the CRA will come back and say that it was a $500,000 sale, and you're going to be paying taxes on that $400,000. Similarly, they will not bump up the cost base for your kid. They'll say that the kid acquired it at $100,000, and if the kid goes ahead and sells it again for $500,000, they'll pay tax again on that same $400,000. So double taxation, very, very unfair. It's a terrible thing to have happen, and it happens regularly. So before transferring any assets between family members, before selling your cottage property for your, to your kid for what you paid for it, or for $1, or before giving it away for free, you must really think about and get some advice from someone like Eugene, someone like myself, regarding the tax consequences. Additionally, I guess I'm just going to jump to number 3 here. One of the major problems with these non-arm's length transactions is that it allows the CRA collector to go after the person who received the asset. So the way it works, before I go through the slides, the way it works is, let's say I owe money to the CRA, okay? I owe $500,000 to the CRA. And let's say I've got $1 million house that I have. And I take my $1 million house, and instead of paying the CRA their $500,000, I take my $1 million house and I transfer it to my wife, okay? And let's say I do that for zero. Let's say I give it free of charge. So if I give it for free, my wife has made what the CRA calls a benefit of $1 million, okay? Let's say I transfer it for $100,000 to my wife. My wife has made now a benefit of $900,000. So the benefit is the amount that that the property is worth, less the amount that they paid. If I sell that house to my wife for $600,000, her benefit would be $400,000 in that case. And the way it works is the CRA, if I haven't paid my $500,000 in tax, and let's say I sell my property to my wife for $600,000, where it was worth $1 million, she's made a benefit of $400,000. The CRA can go after her for that $400,000 benefit that she made. So similarly, if I have a $500,000 in tax that I haven't paid, and I give my $20,000 car to my daughter, the CRA, and I give it for free, the CRA can go after her for the benefit she received, which is that $20,000. So it's very, very important if you're going to be giving assets to family members that you make sure that that you've paid your taxes. Otherwise, the CRA can go after them for any benefit they receive. All right. Similarly, I'll tell you about a court case that happened a number of years ago. There was a mother and an old lady, and her son had his assets frozen by the CRA. So he had no bank account. He had no ability to even pay his rent. He couldn't deposit his paycheck, and he was running off to one of these check cashing places every month to cash his paycheck. And what happened is his mother said, "Listen, son, I have an extra bank account at the Bank of Montreal. Why don't you go ahead and use this bank account? You can deposit all your paychecks. You can use my account, and then whenever you need to pay bills, you can take money out of there. Here's my Interact card. You can use it as if it were your own account." So this son owed, I think it was about $400,000 of taxes. And over a course of 3 years, he deposited all his paychecks, which is about $150,000 that he deposited over 3 years into this bank account. So, the collector eventually found out that he'd been depositing his checks into his mother's bank account. And the collector sent a letter to his mother under Section 160 of the Income Tax Act, which said, "Dear mother, it looks like you have received a benefit of $150,000 from your son. Your son hasn't paid his taxes. Therefore, we want you to pay that $150,000 benefit that you received." So we went to court, and the argument that we made was that there was no benefit. $150,000 went into her bank account, yet $150,000 was given back to her son. Okay, she gave the money back. She didn't benefit at all. And the way the CRA saw it, and the way the judge ultimately saw it, was that the depositing money into her account, as soon as money was deposited, she got a benefit. She didn't pay for that money to be deposited. Okay, and as soon as she let the son get the money back, that was a gift she made to him. That gift was a totally separate issue from the deposits made. So at the end of the day, the judge determined that she did in fact make a benefit of $150,000, even though she didn't actually receive any of the money to keep. And in fact, she had to pay $150,000 of her son's taxes. Now, had there been an agreement in place, had there been a trust agreement in place, for example, where the mother said to the son, and it was all in writing, let's say, "Dear son, you're allowed to use my account. You can deposit it. Once the monies are deposited, they do not become my monies. They're not mine. I'm acting exclusively as a trustee on your behalf. I will not touch the money. I will not use the money. I'm not entitled to the money. It will always be yours, and you can use it whenever you like." Now, had that agreement been in place, then there wouldn't have been a transfer to the mother. She never would have received any assets. She just would have been holding on to his money as a trustee. And had she had that agreement in place, that would have saved her $150,000. So very, very important to consider, does someone owe money when they're transferring assets between family members? It's very important to really give a lot of thought to these non-arm's length transfers. Okay, again, these slides here, this section 69, this explains what I was talking about before, which is if you sell a property to a family member at below fair market value, the CRA will deem that the sale price was fair market value, and there will be a tax payable by the seller. And conversely, on the other side, they will not deem that the price paid by the recipient was fair market value. They'll deem that the price paid was the actual price paid. Therefore, when the recipient resells the asset, There's going to be a double taxation. We should also talk about, in fact, I guess that's probably fine. If you have any questions about this, I'm happy to send over the slides. I know I bore you too much with all the details of the slides, but I'm happy to also answer questions upon this later on. So moving along to mistake number 5, very, very big mistake that people make. It's paying in cash and not keeping proper records. Now, there's no problem with paying in cash. So if a supplier comes up to you, or someone's selling you something and they say to you, listen, pay me in cash, even if they tell you you don't have to pay tax on this, not your problem. It's not your responsibility to pay tax when you're purchasing something. It's the responsibility of the vendor or the person providing those services. It's their responsibility to charge tax. So it's totally fine to pay in cash. However, what you need to make sure of is that you get receipts. Okay, and again, something we'll talk about later, which is the fact that the law doesn't necessarily match CRA policy. In the law, it doesn't say you have to keep your receipts. It doesn't say you have to get receipts. You can certainly claim things without having the actual receipt. However, the CRA policy is, if you're getting audited, the auditor wants to see your receipts. With no receipt, they're not going to give you credit for the transaction. And of course, you can go to court later on, and you can spend all your money on someone like me to take you to court, and you can get up in front of the judge and say, Your Honor, I swear I'm going to tell the truth, so on and so forth, and the judge will likely believe you. But by the point you've gotten to the court, you've already spent tens of thousands of dollars, and it would have been easier just to get receipts in the first place. So if you are paying cash to someone, get a receipt, okay? In fact, get a receipt for absolutely everything. Make sure you keep your receipts. It's easier to comply with the CRA policy and get those receipts rather than to worry about going to court and putting your case later. Actually, I've got a lot of cases where people will build a home, or they'll renovate a home, and they'll pay all kinds of people in cash, and they'll go ahead and they will get audited, or let's say they don't even get audited, but they file their tax returns and they claim all the expenses. What happens oftentimes is the CRA will come back and they will verify if these expenses actually took place. And if there's no receipts, the CRA will say, hold on a second, you claim to have made $100,000 gain by selling this property, but it looks like you made a $400,000 gain. Where's the discrepancy? And the taxpayers will say, well, the discrepancy is I spent $300,000 to renovate it. And then the CRA auditor will say, well, prove that you renovated it. And if you can't come up with receipts, the auditor will just deny the claim altogether. We've got some clever things we do when we're challenging a bad audit like that. Oftentimes we can show before and after pictures when we're in objection. We can show that the property was in fact renovated. We can show that new appliances showed up. We can show that new flooring and new walls and new everything was put into this property. And as long as my client is not a thief who steals all the building supplies, and as long as they're not a thief who stole all the new appliances, as long as they're not a thief and also someone who's in construction, they must have paid someone to do all the work. So there's a process by which we can determine and prove that actual work was done by contractors and actual supplies were purchased for the renovations. But that roundabout way is a little bit more complicated, and it's better to actually have the receipts at the end of the day. So keep every possible receipt. And in particular, what you want to do is, if you're using a vehicle for business purposes and you're claiming your vehicle, you want to make sure that you keep a vehicle log. So a lot of people, what they'll do is they'll say that they used 30% of their car for business purposes. And if their car cost them $10,000 in a year for fuel and for insurance and for maintenance and for the lease, they'll say, well, I should be claiming $3,000 as a vehicle expense. Well, if they're audited, the first thing an auditor is going to want to see is a vehicle log. They want to prove, or they want you to prove that the vehicle was used 30% for business purposes. And the only way to actually do that is by having this log, which the way it works is at the beginning of the month, you write down the beginning mileage for your car. Let's say it started off at 10,000 kilometers. And let's say, or you do this on a yearly basis, started at 10,000 at the beginning of the year. At the end of the year, it ended up at 20,000. So there was 10,000 kilometers driven that year, and you write down every single business trip that you took, and let's say the business trips were all 3,000 kilometers, and you did 10,000 total, there's your 30%. And you can prove that you used the car 30% for business purposes and 70% for personal. And again, if you don't have this log, the auditor will just throw the case out. They'll deny the expenses. Certainly, if you go further and you take this to objections or you take this to tax court, it's possible to reverse the decision of the auditor, but you don't want to have to spend all that money and spend all that effort challenging them. So keep the receipts, keep your logs. Another thing about these cash transactions that people don't realize is that they're audit triggers. So if you're on the receiving end of cash, and that's fine, there's a lot of people who receive cash. Number one, make sure you're charging your taxes, or if you're not, or make sure that the taxes were included in this cash. But you also have to realize that large cash deposits into bank accounts, they can actually trigger an audit. So not only can the bank notify the authorities and FinTrack, and the government will start tracking your finances. They're going to look into things like crime and terrorism financing, but in terms of taxes alone, these cash deposits are something that the auditors love. They love seeing this. A, it can trigger an audit, and B, the auditors love seeing this because they will always, claim that it's undeclared revenue, and it's very, very important that all cash be tracked. And if you don't want to track the cash, if you don't want anyone to know about it, don't deposit in the bank. Don't make any large transactions. Just stay off the radar. But people who take cash and they don't declare it and they put the money in the bank, they're looking at trouble. Similarly, you may think you're clever and you may take all the cash and pay your Visa bill every month. Well, again, if the auditors see that Visa bills are being paid with by cash, they're going to wonder where that cash came from. And if there isn't a corresponding withdrawal from one's bank account, the auditor is going to assume, mostly rightfully, that the cash was undeclared revenue. So be careful with this. And the same goes for, I've got a lot of clients who they go and they sell their jewelry, or they sell assets and they get cash. Track these things, record these things. Even if it's wedding gifts and you got $50,000 for a wedding gift, track that, record it, and make sure that the CRA ever comes back and they audit you, that you can prove what the money was for. Okay, so document everything. So this includes items brought to Canada during immigration. I've got a lot of Indian clients who bring a tremendous amount of gold with them when they move to Canada. And the gold, eventually, you can't live in gold, and GTA is a very expensive place to have a house, so they often sell their gold to buy a house. So you got to track all of these things, or the CRA will assume that you're running some kind of a business. And similarly, insurance settlements, loans, all these things, they should all be tracked, okay? And while we're talking about it and talking about cash and being audited, a couple of tips to reduce the odds of being audited. Number one, first and foremost, is blend. You want to blend in with everyone. If you are if you're an accountant and you're spending 70% of your revenue on your rental of your office, and all other accountants are spending about 8% of the revenue on their office, you got to watch out. If you don't blend with someone else, if you don't blend with your industry, it's a cause for alarm. It's a red flag. If you are selling shoes and your cost of goods sold is 70% of your revenue, and every other shoe store, the cost of their shoes are 25% of their revenue or 30%, there's a big mismatch. You're not blending, and the CRA is going to wonder why, and that's a red flag. If you live in a $3 million home and you're declaring $50,000 of income per year, and everyone else in your neighborhood is declaring, $250,000 per year, that's also a big red flag. So you really, really want to blend with everyone. You want to blend with the people in your neighborhood. You want to blend with the people in your industry. You don't want to appear out of the ordinary, okay? Because those are the things that the CRA computer latches onto, and those are the red flags, and those are triggers for audits, okay? Besides those red flags, and besides not blending, the CRA also audits certain sectors with large amounts of cash. If you're running a Chinese restaurant, they're notoriously high on cash. If you're running a construction business and you're doing framing, or you're doing drywalling, or you're doing tiling or something, those sectors are very, very high on cash. So if you happen to be running a Chinese restaurant, or you happen to be doing tiling, or be in the construction industry, or you happen to be a taxi driver, a lot of these things could just cause you to be audited just because, and there's nothing you can do about that. But the things you can work on, do work on them, and make sure you blend, make sure you don't stick out. Mistake number 6, getting greedy. So it's good to get a little greedy, and when that little greedy causes you to be creative and to make sure that you've taken all your deductions properly and taken all your possible opportunities to reduce taxes, that's great. In fact, I have a book, I'll tell you about it right now. It's called Pay Way Last Tax. There's all kinds of tips in here on how to save money on taxes. And if being greedy means that you've had a business event one day and you ordered way too much food and wine for the business event, and you got leftovers and you use that the next day for a personal party, great. That's a clever way to use a business expense and get a personal benefit from it. But the problem is a lot of people get too greedy. Okay, and when you get too greedy with aggressive tax planning, with tax shelters, with tax scams, inflating your expenses by lying about your income, you're going to lead yourself into trouble. And in particular, you've got to be very, very weary about certain tax preparers. And I know Eugene is not one of these types of people, but there are certain types of tax preparers that you'll encounter who will offer you a massive benefit for donating amounts to charity or for participating in the program. If you normally get a $2,000 tax refund, and some tax preparer is telling you that they can get you 10 or 15 or 20,000 that year, or make sure you don't pay any tax at all, there's something wrong with that scene. There's something wrong with the picture. There's something wrong. It's too good to be true. These things never happen legitimately, and you're going to cause yourself to have all kinds of trouble. And the CRA will come back eventually. They'll find out. They'll reassess you. They'll penalize you. There'll be full interest on all the penalties. It's going to be a very bad situation. So, be greedy enough to take advantage of a good accountant and make sure that they give you all the possible deductions, credits that you're entitled to. But don't be so greedy as to let yourself fall victim to one of these tax preparers who sells you some magic beans. All right. And again, this just talks about this slide here. Most audits, 46.7% of audits are targeted. They're based on risk assessments. The odds of being randomly audited, 12% of audits are random. You just lose the audit lottery. But most audits are because you've gotten a refund which is way too big, or you haven't blended with your industry, or there's some kind of a red flag. So again, if you're normally getting $2,000 a year as a refund, and all of a sudden your refund jumped to $12,000 and you're getting the same income, that's a big red flag, and the odds are you will be audited. And you have to remember, when dealing with an auditor, is that the auditor's job is not to see if you've been a good taxpayer. It's not to verify. Their job is to make more money for the CRA. So they're going to come in. It's a very adversarial process. They're going to come in. They're not your friend, and they're going to try to find as many ways as they can to reassess you and cause you to pay more income tax than you have to. All right. And again, this slide talks about different matching. So they'll match all kinds of stuff. They'll look to see if you have excessive expenses. They'll make sure your margins are consistent with your industry. They'll make sure that you haven't had too many consecutive losses. They'll check inconsistencies between your tax returns and other people's. If you're an HST filer, they'll make sure the numbers on your HST returns match the numbers on your tax returns. So you don't want to stick out. You don't want to give them any opportunity to be suspicious and to find you. This year, also get a lot of information from third parties. Disgruntled ex-wife or ex-husband, anonymous tips, information from other governments. So the information comes from all sources, and they also look, again, at aggressive tax planning. So the key is just don't be too greedy, and don't give them reason to find you. All right. Mistake number 7, not challenging a bad assessment or audit. So a lot of people think it's really too expensive to challenge. A lot of people think that they don't have a good chance of challenging an objection. The answer is you can actually do it yourself. So you don't always need a guy like me to file an objection. I'm an expert at it, and I've done millions of them, or at least tens of thousands of them. But you can do it on your own if finances are a problem. What people also don't realize is that once you file an objection to a personal tax return or to a corporate tax return, and I'm not talking HST, I'm not talking GST, I'm not talking payroll, but regular income tax. Once you file an objection, the collector can't actually collect from you until the objection is finalized. So that's actually one of your one of your rights. You have the right not to pay what they've assessed until such time as the objection has been finalized. So a lot of people, I counsel them to just file an objection just to hold the collector off, if for no other reason. All right. The way the objection starts is, or even before that, once the audit completes, the auditor gives you a proposal letter. They give you 30 days to challenge them. Typically, the auditor won't listen to anything in that proposal letter or in the response. They've already made up their mind. So they'll go ahead and they'll file a reassessment. But again, 90 days following the reassessment, you have to file the notice of objection. Okay. And again, once that notice of objection comes to a close, if you don't like what happened, you have 90 days to apply to the Tax Court of Canada. Okay. And again, if it's not an assessment or a reassessment that you're challenging, but the exercise of someone's discretion, whether they're going to give you relief, whether they're going to accept a payment plan, all the weather questions, all those discretionary decisions can be challenged by judicial review in the federal court, and you have 30 days to do that. But we've already talked a bit about this. The CRA policy and the law are different. So law is created by Parliament. The CRA is an administrative agency which creates policies, okay? Parliament and the government gives the CRA discretion to do certain things, but they have to exercise their discretion reasonably. Again, this goes back to the rule of law. They can't just be arbitrary. They can't deny your payment plan because you're the wrong religion, or because it's the wrong day of the week, or because you drive the wrong car. They have to deny your payment plan because you want to pay $2,000 a month on a $2 million debt and you'll never pay it off. That's okay, but they can't make an arbitrary decision based on their whim. Right? So it's important to challenge the CRA when they do make these decisions which are arbitrary. It's important to challenge them and go to judicial review. And it's important to realize that when it comes time to challenging them, if the law doesn't say you need to keep receipts and you don't have any, let's say they blew away in the wind, or you lost them when you moved, or a flood took them away, just because the CRA auditor says that no receipt, no expense, doesn't mean a court will say that. The law oftentimes is very, very different from what the CRA says. So if there's ever a question about what the law actually is, what your rights are, consult someone like me. I'm happy to talk to you about this. And it's important to remember that the CRA does what is most convenient for them and what's easiest for them. So they'll make up all kinds of policies which aren't necessarily according to the law. Okay? Mistake number 9. So a lot of people are directors of their own companies, but a lot of people also become a director of their spouse's company, of their friend's company. A lot of people they're asked to be put on as a director. And a lot of individuals don't realize what a serious consequence it could be to act as a director. And most importantly, there's a concept called director's liability. And what it says is that a director is personally liable for trust amounts. And trust amounts are HST or GST amounts, which aren't paid. Pardon me, and they're also payroll amounts, source deductions. So if a company has not made its payroll remittances, or if a company has not sent in its GST or HST payments to the CRA, the collector, when they're collecting the money, they will look to see who the directors are, and they will very, very likely, almost 100%, assess those directors personally for the HST or source deductions liability of the company. So it is very important, if somebody asks you to be a director of their company, make sure you do so with your eyes wide open. Make sure you understand the consequences. If you're acting as a director for a corporation, make sure you're watching that corporation actually files its HST returns and its payroll source deductions. So very, very important to watch that carefully. And sometimes you don't actually have to be a official director to be liable. You can be working or acting as a de facto director. So the way it works is, if you're doing these things that a normal director would do under normal circumstances, even though you're not listed as a director, the CRA collectors can say, hey, you know what? We think you were acting as a director. We're going to call you a de facto director, and we're going to assess you for source deductions or HST amounts that were paid. So very, very important to look at that. Similarly, if you're not just working on someone else's corporation as a director, but you're acting for your own corporation, make sure you do all those things that are necessary to make sure that the corporation pays these amounts. Now, if a corporation doesn't pay their HST and you were acting reasonably, you did everything possible to make sure they paid it, there is a part of the Excise Tax Act where the CRA will actually relieve you of liability if you can prove that you exercise the degree of care and diligence and skill which is required to prevent the failure. So it's a hard test to satisfy, but if you can prove to the CRA that you were doing everything right, and still, despite doing everything right, the company still couldn't pay its HST, then you may be let off the hook. But again, it's a very small chance for that. So if you're going to be a director of your company or someone else's company, make 100% sure that that company is paying its HST, its GST, and its source deduction. Because I've seen many people's lives ruined, and I've seen many people have to go bankrupt because of the director's liability. Finally, mistake number 10 is not getting help from an expert when warranted. So there are many different times when you should get advice from an expert. Oftentimes this advice can come from your accountant. Accountants are very skilled with many things, but you also may need a tax lawyer at a certain point in time. So I'm happy to provide advice. I'm always happy if people call me before they get into trouble to find out if they can or can't do something. I know Eugene is in the same position. I'm sure he'd rather give the advice beforehand than have to try to fix the problem after the fact. So very, very important. If there's any question about a transaction, if there's any question about anything and you're not sure and you think this thing, whatever it is, may get you into trouble with the CRA later on down the road, get advice from an expert. All right? So that is the presentation. I'm happy to take some questions now. Let me jump back in here. All right.
Okay, thank you, Dale, for a great presentation. We will now move to Q&A part of webinar. And as a reminder, you can type your questions in the chat and we'll have Dale answer your questions. I noted that many of you who join us today are actually accountants, so I'm expecting you guys to start first, maybe, with all the tricky questions you might have.
By the way, if you're mostly accountants, you should take a look at this book here. Another one of my best-selling books. This is called Victory Over the CRA, an accountant's guide to representing a client. So this book has a lot of information about the appeals process and audit representation and tax court. So it's really a very useful tool for accountants to help represent their clients. And of course, if you want to ask me questions offline, I'm happy to answer them. If you don't want them done in the course of this webinar, I'm always happy to answer them. And there you go.
Okay, Debbie, you have raised your hand. If you'd like to ask your question utilizing microphone, go ahead.
Oh, Debbie, you're muted. Oh, there you go.
Can you hear me now?
We sure can.
Okay, thank you very much. Great presentation.
Thank you.
My question is, how responsible is somebody if their spouse dies and he has owed taxes for approximately 25 years?
Good question. So number one, if you're not in general responsible for your spouse's taxes, okay? However, if over the course of the last 25 years, since the debt has existed, the spouse has been giving assets to the surviving spouse, whatever those assets are. Listen, if the deceased spouse has been giving the other spouse $2,000-3,000 a month, whatever the number is, to pay rent and mortgage and household expenses, that's great, and that's fine. You can not normally be assessed for that. If the deceased spouse transferred larger assets to the surviving spouse, then the value of those assets, whatever benefit was received by the surviving spouse, they could be forced to pay the taxes. Similarly, if in the will, for example, let's give some numbers. Let's say the deceased spouse has a $200,000 tax debt, and in the will, the surviving spouse gets like $300,000 worth of assets in the will. Got those assets for free. It's a benefit that they received. And those, as far as the CRA is concerned and the law is concerned, that $300,000, $200 of it should have been paid to the taxes by the deceased. They shouldn't have been able to give their spouse all $300,000 worth. So the CRA will go after the survivor for that $200,000 to make sure the tax debt's paid. But let's say there was nothing that deceased person gave to their spouse upon dying. Their debt to the CRA will die with them. They can't go after the spouse if the spouse didn't receive any transfer of assets.
Yeah, okay. Yeah, because we kept our accounts separate, and he had nothing when he died, and therefore had no will when he died because he had nothing. However,
Okay, so,
I'm the one that has stuff, and
okay, yes. So if he had nothing, he transferred nothing to you.
correct.
Then the collector cannot go after you for his tax debts. It's not your job to pay his tax debt just because you were married to him.
Right. He was an independent contractor, so he, his business debts were his business debts. I never
Right.
saw
Yeah,
any
it's
of
got
them.
nothing to do with you. As long as there was no transfer of assets, you're free
Okay.
and clear.
I was just leery of contacting the CRA so they
Right.
come
Understood.
here and
You don't even
handcuff.
have to, and if there were no assets to transfer upon death, nothing in the will, no assets, you don't even have to bother filing his terminal tax return. You can just walk away.
Okay, great answer. Okay, let's move to Aisha. Aisha is asking, what is your advice on owner withdrawing money as a management fee versus salary or T4A from the corporation?
Management fees, I don't know. I mean, it's a corporation, right? I mean, I like when people are paid in dividends. I think it's really nice and clean. You don't have to worry about management fees. The problem for me is that you have to charge HST on your management fees. Okay, and then you get HST filings to do, and then you've got to make sure that they're reasonable. If it's just a dividend, it's so much easier. And I don't normally love when people pay themselves payroll. Although the nice thing about payroll is that, again, going back to non-arm's length transfers, when a corporation pays its shareholders a dividend, a shareholder is a related party to their corporation if they're, let's say, the sole owner. So when you're paying yourself in a dividend, if the corporation doesn't pay its income tax, and the corporation has an income tax debt, if you paid yourself in a dividend, the CRA will go after you under the shareholder under Section 160 for having received a benefit, a non-arm's length benefit from the corporation. So you could actually be forced to pay back the corporation's the dividend that you received. In the case of a T4 income, the CRA can never claw back from you the income that you received from the corporation. But the converse picture is that the corporation, if it didn't have enough money to pay you completely and also pay its source deductions, if you're also a director of that company, the CRA can now assess you personally for director's liability in respect of the source deductions which weren't paid by the corporation. But having said all of that, as long as the corporation pays its taxes, I usually prefer dividends as the preferred way to pay a shareholder.
Okay, great. Now, Ursula, you have raised your hand. You can unmute yourself and ask the question.
Hi, thank you. Good afternoon. Great presentation. I have a question related to rental income. When they are a spouse, just one partner can claim the rental income, or they have to share the income, or I don't know.
Good question. So spouses can actually get in trouble for sharing the rental income unless they own the property jointly. And there are certain rules in the Income Tax Act which will prevent, if I own a property, and I'm trying to get my wife, who earns much less money than me, I want to put the rental income on her taxes, that's something I cannot do. They want the person who owns the property to pay the income tax on the rental income. Similarly, there's also attribution rules. So even if I earned all the money to buy the property and I give this money to my spouse or to my kid and I have them buy a property, if they use the money to buy a property and start generating income on it, the income could be attributed back to me again. So you want to be cautious with this, and you want to make sure that you're not putting income onto a party that didn't actually buy the property and who's not listed on title.
Okay. Anybody else? Quiet. All right, we're almost getting into 1 hour allocated to us. Um, Thank you, Dale, for the informative presentation. And before we sign off, I would like to remind everyone that the recording of the seminar will be available on our YouTube channel. And if you would like to get noticed when this is posted and hear about upcoming seminars, please sign up for our newsletter on our website. Thank you again, Dale, and the team at Barrett Tax Law for a great presentation. Thank you so much.
Thank you very much. Thank you. Just remember as well that if you have any questions in the future for yourself or for your clients, I'm always happy to provide answers for you. And a large component of my business is supporting accountants and their clients. So I'm always happy to provide a free consultation for accountants. All right. Thank you so much. Eugene, thanks for having me.
Thank you, Dale. Thanks a lot. Okay. Bye-bye.
Bye-bye.